Good morning, everybody. Good afternoon, good evening, whatever time zone you're in, wherever you're at in the world. If you're new, thank you for dropping by. Hopefully, you'll subscribe. If you're coming back, thank you. And if you have any comments or anything, please leave them below on anything that you might want to see regarding wealth building strategies. So, we do money, investments, careers. These are some of the things, money tips on saving money. And today it's going to be one of the stock videos. So I'm going to go off the screen and I'm going to give you some of the 7 of the 10 best Dow stocks in the last 3 months. And this is going to be April, May, and June of 2022. Okay, so these are going to be some of the best going on right now according to... Let's see, who is this according to? We're going to do Morningstar Direct. We are going to do Fund Sponsor and Yahoo Finance. Okay, these are some of the people that I'm getting these resources from. Just so you don't think I'm making this up off the top of my head. So, portfolio doctors prescribe high dividends to remedy rising interest rates and stiff inflation. Now, I've been doing a lot of videos in the last 2 weeks, putting them out on dividends, portfolio, different ways you can try and fight inflation. So the first year in recent memory postmarked by those twin afflictions, dividend-heavy stocks, utilities, pharmaceuticals, pipelines, consumer-oriented blue chips, have held up fine. There's a massive disparity of results within the next New Year's stock, mutual fund, and exchange traded listings. It's the FANGs, FAANGs, or whatever we call them now. It's the remaining of Facebook and Google that are a ball and chain. Your basic core S&P index fund, the down double digits, and that goes for real estate investment trusts, master limited partnerships. So as we hit 2022 midpoint, because I'm filming this in July of 2022, the most upbeat performance stories underscore the passion for dividends. So the top members of the Dow Industrial Average begins with the year with the highest yields that are in the best. So let's look at some of these. I just did a video on the stocks to pounce on, so we're not going to do that on this video. But let's look at some of these preferred FTEs. So let's look at Chevron, which is the oil company, and I don't think it's on this one. Maybe not. Let's go back here. Okay. So let's look at this one, and Chevron is an oil company. Dow, the chemical giants, up 20.7. The sports dividend yields from 2.8%, which is Coca-Cola, to 4.7%. So IBM, I think IBM's 4.7 yield is a leading reasonable, up to 8%. While a typical tech fund has coughed up a quarter of its value. So a pair of ETFs, Alps sector dividend dogs. Is that on here? Alps. Let me see. No, that's not on here either. Okay. No visual for that. Sorry. Okay. Alps International Sector Dividend. iDog, $28. Symbol S-Dogs, $55, are scaring off the bears with year-to-date returns of 4.4 and 2.6 respectively. These funds are not replicas of the dogs of the Dow, but use a similar methodology across numerous sectors. S-Dogs past 4 quarters distributions combined worked out 3.6 yield, and better yet, the payments have been growing with each distribution. Securities I recommended are in bold, which I believe is these right here. And to further this, our furry friend theme, the caterpillar in the Dow industry. Not a 2022 dog, but it's up 8.9% this year. And one of the best years in CAT is swimming in cash, and may promise dividends increasing in the yield. I guess because of these home building things. I'm guessing that's why CAT is up. So They hit the single digits shortly, and in the next 3 years, although the 2% yield exceeds the S&P 500, the Caterpillar could write off still bigger checks as it opts to emphasize cash payouts, stock buybacks, practice investment managers. And you can't fudge these dividends, says Henry Hank Smith, a dividend fan who is the head of investment strategy for Haverford Trust Company. So the July, let me see. Legg Mason, low volatility, high dividend ETF, LVHD, $39. Let me see if I got a visual for that. I do not. Do not have a visual on that. So you're just going to have to listen. So this one here is twice nominated for the Timely Tactic of the Month. It's off 1.3%, but it's an excellent compared to the broad market. The ETF's up 3%. Yield is reliable. 2 thumbs up for dividends that catch regular criticism as a lazy use of capital or drag on future growth. So those are some of the top ones that are recommended. Now, ETF, should you prefer preferreds? Okay. So in a topsy-turvy stock and bond market, preferred securities may provide extra income and a small dose of stability. And these hybrid investments are part bond, part stock, and their dividends get paid ahead of common stock dividends. So these days, preferred stock typically yields 6.6%, better than the current 1.6% of the S&P index, and the 3% yield of the Bloomberg U.S. Aggregate Bond Index. Preferred stock exchange funds have tumbled along with everything else in the last 12 months, and they suffered about half the volatility of the stock market. So Global X Super Income Preferred ETF, which I have at the top. I do have my picture for that one. Invests in 50 of the highest yielding preferred stocks in the U.S. and Canada. Over the past 12 months, the funds lost 5.9%, which is better than the 8.4% drop in the Ag Index. At current yields, this could be an attractive entry point for investors who want to withstand a certain level of volatility and risk. Among the caveats, the like bonds. Let's go back down here and look at sector weightings. I will probably put this up on another video, but right now we're going to look at this right here. And this one here is, these securities are sensitive to interest rate moves, bond rates, and prices that move in the opposite direction. So their preferred securities typically sport lower credit quality ratings than traditional bonds. And more than half of the funds invested in securities with below investment grade ratings. Preferred security stocks are historically experienced. They have very low fault rates, and the lion's share of the securities is in ETFs. And they currently have strong balance sheets, especially they held up during the pandemic. So these are some of the things you could consider. So this is just a shorty video. Keep you all motivated, hopefully. And I'll try and do these like every month as much as possible. So I thank you all for watching. Please come back soon.